Something unusual is unfolding in the financial world right now, and most people are either missing it entirely or misunderstanding what it actually means. On the surface, the headlines look confusing. Some analysts claim gold and silver are weakening and that the metals rally is already over, while others insist this is only the beginning of a massive bull market. Investors scrolling through financial news see completely opposite narratives every day, and that contradiction alone creates uncertainty. But markets rarely move because of headlines alone. They move because of a complex web of forces that include inflation, central bank policy, geopolitical tension, oil prices, currency strength, and investor psychology. When all of these forces begin interacting at the same time, the financial system can enter periods of confusion where prices behave in ways that seem unusual. That is exactly what we are seeing right now in the precious metals market. To understand what might happen next, we need to look beyond the daily price chart and examine the bigger global story that is developing behind the scenes. Over the last several months, geopolitical tensions have been rising rapidly, particularly involving Iran and the broader Middle East. This region is one of the most important energy hubs in the world, and any disruption there can instantly affect global oil supply expectations. In fact, analysts have warned that disruptions involving Iran or the Strait of Hormuz could send oil prices sharply higher because a huge portion of the world's oil supply moves through that narrow passage. When energy markets become unstable, inflation fears begin to spread throughout the global economy. Higher oil prices increase transportation costs, manufacturing costs, and eventually consumer prices across nearly every country. That is why geopolitical tensions involving Iran have recently caused volatility across commodities, currencies, and precious metals markets. In some cases, the reaction has been counterintuitive. Instead of gold and silver rising smoothly during the latest tensions, markets have become extremely volatile, with gold even experiencing sharp short-term declines as traders respond to interest rate expectations and liquidity conditions. This highlights an important truth about modern financial markets. Geopolitical risk does not always create immediate price increases in safe haven assets. Sometimes the chain reaction works differently. Rising oil prices can push inflation higher, which then makes central banks less likely to cut interest rates. Higher interest rates strengthen the US dollar, and a stronger dollar can temporarily pressure gold and silver prices. This complex interaction between geopolitics, energy markets, and monetary policy is one of the main reasons the precious metals market looks so confusing today. Many investors expect a simple relationship where conflict equals higher gold prices, but the reality is more complicated. Short-term liquidity flows, derivatives trading, and currency movements can overpower the traditional safe haven narrative for weeks or even months at a time. At the same time, another important story is developing inside the silver market itself. Silver is a very unusual asset because it exists in two worlds simultaneously. Like gold, it acts as a precious metal and store of value, but is also a critical industrial metal used in modern technology. Silver is essential in solar panels, electronics, medical equipment, electric vehicles, and many other technologies powering the global economy. Because of this dual role, silver often behaves differently from gold during certain economic conditions. When industrial demand is strong, silver can outperform gold dramatically. When economic growth slows, industrial demand can weaken temporarily and silver may lag behind. But what many people overlook is that the global silver market has quietly been running supply deficits for several consecutive years. In simple terms, the world is consuming more silver than mines are producing. Structural demand from renewable energy and advanced electronics continues to grow while mining supply struggles to expand quickly. Analysts estimate that the silver market could remain undersupplied by roughly 10%, creating long-term pressure that may eventually influence prices. Meanwhile, gold plays a slightly different role in the global system. Gold is less about industry and more about monetary stability. Central banks around the world have been increasing their gold reserves as a hedge against currency volatility and geopolitical uncertainty. When governments accumulate large amounts of gold, it often signals concerns about the long-term stability of the global financial system. At the same time, global debt levels have reached historic highs. Governments across the world have borrowed trillions of dollars over the past decade to support economic growth and manage crises. When interest rates rise, the cost of maintaining that debt increases dramatically. Policymakers must balance the need to control inflation with the risk of damaging economic growth. This balancing act creates constant uncertainty about future interest rate decisions. Investors try to anticipate those decisions months in advance, which is why financial markets react so quickly to economic data, central bank speeches, and geopolitical developments. The Iran situation adds another layer of complexity to this already fragile environment. Any escalation involving Iranian oil infrastructure or shipping routes could tighten global energy supply and trigger new inflation waves. That possibility alone keeps traders on edge and adds volatility across commodities markets. Historically, when global uncertainty rises, gold tends to attract attention as a store of value, while silver may react more dramatically because its market is smaller and more sensitive to supply changes. But in the modern financial system, there are many additional forces at play, including algorithmic trading, derivatives markets, and massive institutional capital flows. These forces can distort price movements in the short term, even when long-term fundamentals remain supportive. Another factor influencing precious metals is investor psychology. Markets are not purely mathematical systems driven only by economic data. They are also influenced by fear, speculation, and herd behavior. When large numbers of investors believe a certain narrative, their collective actions can temporarily push prices far beyond what fundamentals alone would justify. We have seen this many times in history, from stock market bubbles to commodity booms and crashes. Precious metals are not immune to these cycles of optimism and pessimism. During times of uncertainty, investors search for signals that confirm their expectations. Some interpret rising geopolitical tensions as a reason to buy gold aggressively, while others focus on interest rates and sell metals because they expect stronger currencies. These conflicting interpretations create the volatility that traders are witnessing today. But beneath the daily noise, the broader global story continues evolving. Geopolitical tensions, energy markets, inflation pressures, technological demand for industrial metals, and central bank policies are all interacting simultaneously. None of these forces operate in isolation. They constantly influence one another, creating a complex financial environment where simple predictions rarely capture the full picture. For investors trying to understand the future of gold and silver, the most important step is stepping back from short-term headlines and observing the larger patterns forming across the global economy. Oil prices, central bank policy decisions, inflation trends, and geopolitical developments such as the Iran situation will continue shaping market expectations in the months ahead. Precious metals have played a role in financial systems for thousands of years, and they continue to reflect the balance between stability and uncertainty in the modern economy. Whether the next major move in gold and silver comes sooner or later, the forces driving that move are already building beneath the surface. Markets may fluctuate in the short term, but the deeper economic and geopolitical dynamics shaping the world today suggest that the story of precious metals is far from over.